אחר הצהריים טובים, כאן אסף רוזנהיים, אני דירקטור בפרופימקס, והערב אנחנו מתחילים סדרה של וובינרים על קבלת החלטות השקעה בשוק גלובלי משתנה. זו סדרת מפגשים וירטואלית עם מנהלי השקעות בינלאומיים, ועוד כמה דקות אני אציג 2 מהם. הסדרה שלנו מתחילה עם אחד הנושאים הכי חמים בשוק הנדל"ן, Multifamily. והשאלה היא, איך אפשר להרוויח כסף בשוק שכרגע נשמע או מרגיש מאוד מאוד רווי. הפרק היום, המפגש הראשון שלנו היום, הוא חלק מסדרת מפגשים עם מנהלי נדל"ן מובילים בעולם, כאשר המפגש הבא יתרחש ב-20 למרץ ונדבר על בניית העושר, וב-9 לרביעי נדבר על רכבת הערים שבה אנחנו נמצאים כרגע בשוק הנדל"ן. לאחר כל מפגש כזה אנחנו גם נציג מידע מפרופימקס, מידע מהמחלקות שלנו, ממחלקת המחקר, ממחלקת ההשקעות, וגם הקרן השישית שהתחילה כבר לעשות את ההשקעות שלה. אבל אי אפשר להתחיל לדבר בלי לציין שיש 134 חטופים בעזה וכולנו מחכים לשובם. לפני כמעט 5 חודשים ישראל עברה את אחד מהימים הקשים בתולדותיה, אם לא הקשה ביותר, ומאז החיים שלנו נראים לגמרי אחרת. באתר האינטרנט שלנו תוכלו למצוא מידע וגם השראה על הפעילות שפרופימקס עשתה מאז 7 לאוקטובר. אם זה בתוך המשרד, בדאגה לעובדים ולעובדות שלנו ולבני המשפחה שלהם, אם זה המעורבות שלנו דרך העובדים במיזמים שדאגו למילואימניקים ולמפונים ולמשפחות ולמילואימניקיות, אספקה של אוכל, גנרטורים ומקלחות לחיילים, חמ"ל חרדי, ניחום אבלים ארצי, אספקה על הנגשה של עסקים מקומיים, הקייטנה שהייתה לנו פה לעובדים כדי שיוכלו לתת שירות יותר טוב למשקיעים שלנו, ויריד כחול לבן שעשינו למטה בחצר. אבל לא פחות חשוב, זו התמיכה מהשותפים שלנו, שביחד ההיקף השקעות שלהם מעל ל$100 מיליארד, שחתמו על מכתב תמיכה מאוד מאוד מרגש. 2 of the partners who signed this letter of support for Israel are here with us this afternoon, this morning, their time, Max and Russ. And I'm going to let you introduce yourself. I'm just going to tell everyone else that's on the call that you're more than welcome to put your questions in the Q&A section, and we're happy to answer them either during the next 25 minutes or just at the end. I also want to share that this conversation is being recorded, so if you miss anything, you can come back and listen to it later. So we're going to start with the younger one of the 2 of you, Russ. That's right.
Asaf, I think you have to turn my video on.
Here we go.
Yep.
I'm definitely not the younger of the 2 of us, but thank you, Asaf. First, I just want to say that from Boca Raton, Florida and New York, our hearts are with all of you guys. I'm here in Boca Raton, Florida. Pradium is very appreciative for the partnership we've had with all of you and with Profimex, a really terrific organization, and it's been a terrific partnership for the Pretium team. So I just want to start first by letting you guys know our hearts are with you, and second, being very appreciative for the relationship that we have. Pretium is a 33-year-old real estate investment firm that actually started out as part of an investment bank, first Boston and Credit Suisse. It was spun out in 1999 and has been an independent company ever since. For the past dozen years, our focus has been exclusively market rate multifamily properties, and we've been an active investor, over that period of time. Domestic only in the U.S., today focused only on the high growth markets in the South and the West primarily.
Thanks. Max?
First of all, thank you everybody for your time. Echoing what Russ said, our hearts are with you. You have our unequivocal support. I say that on behalf of myself, my partner, our organization. Profimex has been a wonderful company to do business with, as has all of its investors. We were in Israel as recently as November of 2022. We were scheduled to go out there earlier this year, but unfortunately we had to cancel because of the tragedy that happened on October 7th. But look forward to a swift victory in the war, and hope to see all of you by the end of this year. A quick bio on us. I started out as a broker. My partner started out on the debt side. That was about 23 years ago. We both always wanted to be on the principal side, and we started buying for our own accounts, value-added multifamily. I was brokering in Los Angeles, in a suburb of Los Angeles, and naturally that's where we started buying. We've been doing it since 2006. We were very fortunate to have a timely exit of our portfolio in 2008. And in 2009, 10, 11, 12, we did nothing but non-performing debt secured by multifamily and multifamily REO. We did about 20 deals during that period, again, exclusively with banks, Fannie, Freddie, seller servicer. And then coming out of that, we went to the value add business, and have been doing that ever since. We are now in 8 states, 13 markets. And like Russ, I moved to South Florida in 2021 during COVID. We moved from places that were less friendly to our business. I mean, that's at least why I moved. Most of our portfolio at that time was in California and Oregon. And my partner and I had a conversation in 2020 that it would probably be wise to diversify into states that are a little bit more friendly to our industry. And I moved to Miami first and got the office off the ground. We now own a little over 2,000 units in this part of the country, of about 6,700 units total. We're in Florida, Georgia, and the Carolinas out of Miami. And our LA office covers California, Oregon, Colorado, and Texas.
So we're actually going to talk about people moving out of major cities into these parts of the US as a national phenomenon and how that impacts the real estate transaction. But I want to tell you something that you might not know, something that might seem to you like a very, very far memory. In Israel, the Israel National Bank actually lowered the interest rate for the first time in January. That's something that hasn't happened in the US for approximately 2 years. So everyone knows that we're in a very high interest rate environment. And I want to ask you how that impacts your borrowing costs, which is one of the main elements that affects every real estate transaction. Maybe starting with you, Russ.
Sure. Interest rates have gone up. As you've said, Asaf, I think our borrowing costs, before the, early in the pandemic, were about, for 5-year fixed rate debt, about 2.5%. Today, rates are down a little over the past couple of days, but they're, some number between 5.75% and 6%, something like that. Now, we were fortunate. We pretty much have no real legacy issues. We sold, other than the fund we're currently investing, We sold everything in 21 with a few assets lingering into 22. So we're generally a fixed rate borrower. Costs are up. To borrow on new deals, our average cost of debt is still very low on earlier deals, but interest rates are up, and that's impacted values. And you know, again, we have no maturities this year or next year, so we have no kind of immediate challenges due to that. But it's making new deals much tougher.
So maybe dividing your answer into two, as an owner or a potential seller, you don't have any legacy deals, you sold most of them before rising interest rate and were able to get out of them. But as a buyer, right now it's tough, and maybe that's one of, yeah, and one of the reasons that you've extended the investment period of your fund. Max, what about you?
We do have properties in portfolio. We did have our largest year ever for dispositions in 2022, but we did also buy quite a bit in 21 and 22. Fortunately, most of our portfolio is hedged. We're about 2/3 floating, 1/3 fixed. Most of the properties are hedged. We've got a few with you that we bought during that period, and those are all hedged. So they're hanging in there. We've got a couple maturities, 3 maturities at year end 2024. Nothing imminent in the next few months. And we expect to be into a rate cut cycle by then. And those properties are generally okay. We're already speaking with the lenders about extensions, and they're fine with it. As far as acquisitions go, as you know, we have had a few acquisitions. As Ross said, it has been very frustrating, but that's to be expected. That's how every downturn works. The bid-ask spread widens. Transactions plummet because sellers don't want to meet the market. You get 18 months into that, and then they have to meet the market. Certain sellers have to meet the market, and deals start to take place. We just bought a deal with you guys at a 7 cap here in Florida. We're working on a lender-driven short sale right now. So there are folks who are motivated, and there are transactions that have to take place. So transaction volume has fallen by 80%. That 20% that remains, it's either folks that have owned the properties for a very long time and they're deep in the black, or for sale. So we are trying to take advantage of as many of those as possible while values are down over the next 12 to 18 months.
So right now, if someone is selling, either they've captured all the value out of the deal and they're happy with it, they've had it for a long time and they're willing to sell and go on, or they're in distress. And you just said that we bought a deal, a multifamily transaction in a 7 cap. What would that have been trading in 6 or 18 months ago?
So that property would have traded for somewhere in the 4s. Just, to give you an example of actual price per unit, we have 2 properties in our rent comp set that's sold since COVID. One sold for $220 a door, one sold for $250 a door. We bought ours for $150 a door. So we're $70 a door and $100 a door below those 2 in basis. Significant discount.
So significant discount if you can buy, but a very small amount of transactions to look at right now. But that is very different from where we were 2 years ago, when interest rates were pretty low, and you could have even get a construction debt for pretty low interest rates, which means that there was a lot of new construction. So at this point in time, there's a good number of new units coming into the market. How are you dealing with that? And how do you see new transactions competing with a pretty saturated rental market?
Is that me, Asaf?
That's you. That has your name all over it.
Well, listen, if you look at sort of the deals that we've done in the current fund and the prior 2 funds, actually a majority of the deals we bought were new properties purchased in lease-up. So from an acquisition standpoint, particularly with some of the dynamics that Max was talking about, actually all these new deliveries create a pipeline of opportunity for us. So while Max, like you, we've been patient in this environment as generally values have been falling, we're really excited because this plays to our strength. Most of what we've done over the past approximately 10 years has been purchasing new properties and lease up, stabilizing those properties, not taking construction risk, but taking some of the lease up risk. And obviously that's part of the constipation in the marketplace right now, is all the new deliveries. Now, the deliveries obviously are more stressed because they start from zero occupancy and they have to lease up. And again, I think, Max, that's what you're talking about, which is where are the pressures in the market, and taking advantage of the pressures in the marketplace, where are those mislocations, and that's really what we're looking for. The good news for us is this is exactly what we've been doing, and now we'll have the opportunity to do it in a more stressed environment.
Max, any thoughts on that?
Yes. So to answer your question on supply, how are we managing supply? It just depends on the market. So a lot of our portfolio is on the West Coast, which is fairly supply constrained. So as much as people don't love the blue states, and the blue states have gotten a fairly negative stigma over the past few years, like California and Oregon, right now they're actually doing pretty well because they're so supply constrained operationally. In some of our other markets, in some of the Sunbelt markets, we've purchased at a low basis and we're not terribly affected by supply. Even in Orlando, where we have a 2010 built property, we bought it below replacement cost, and there's some supply coming in around that asset. But we've been fine. It's been leasing very, very well. Haven't had a lot of turnover. It's important not to forget that the other side of supply is demand. And a lot of these markets that have a lot of supply also have a tremendous amount of in-migration and job growth and everything that you look for on the demand side. So the supply demand balance has been fairly strong. Touching on what Russ said, yes, there are dislocations in the market with new construction. We haven't bought nearly as much of that as Russ has. We did buy one during COVID and we did spectacularly well on it. We're looking at a few right now, and that is one of our target acquisitions.
So this is actually a good segue. You moved from LA to Florida. Russ, you moved from the New York metro area to Florida. And Max, you just described focusing both on these markets, the Sunbelt markets, and maybe you can explain a little bit what you mean when you call the Sunbelt market, but also some of the blue cities and blue states which investors have stayed away from in the last few years that are seeing some opportunities. So if you can talk a little bit about the geographical focus.
Sure, I'll start. Oh, Russ, go ahead.
No, please go ahead, Max.
Okay, so Sunbelt would be just the southern part of the U.S., what's sometimes referred to as the Smile States. Florida, Georgia, Carolinas being Eastern Sunbelt, into Texas, and then Arizona, New Mexico. Used to be California, but not really as much anymore. That's a bit of a different animal. So those states, as a general rule, are typically more business friendly. It's easier to develop. They're very sparse on red tape and bureaucracy, and it's much easier to pull a permit and put the shovel into the ground. Therefore, in those states, even though it's more business friendly and easier to operate, you get more supply. In some of the blue states, like California, New York, Northeast, all of the West Coast, you get the benefit of being more supply constrained because it's harder to build, but landlord-tenant is much more difficult. So how does that affect us today from a fundamentals perspective and an operational perspective? There is opportunity in the blue states as well as the red states. And where that opportunity is, in our opinion, is the low supply suburbs that haven't had nearly as many quality of life issues as some of the deep blue urban metros. And I'll give you an example of that. Like for us, we would not buy right now in San Francisco. It's got significant challenges with homelessness and crime and everything that you see on the news. That's all real, that all exists. And it's extraordinarily difficult to operate. They don't like landlords. That's just fact of the matter. However, the surrounding suburbs of San Francisco and some other parts of Northern California have a lot of opportunity. We actually got awarded a property in San Jose as an example, newer vintage deal. It was built in 2020 or 2021. It was trading at a big discount to replacement cost. We had a few other acquisitions going at the time, and we didn't have the capacity to buy it. So we actually gave it to a friend of ours who was in an exchange, and they bought it. And that's, I think, a phenomenal profile of investment to buy. San Jose doesn't have nearly the issues of San Francisco that San Francisco has, the ones that I mentioned earlier in the call. And it's got a lot of in-migration. It's got a lot of return to office. Silicon Valley is still Silicon Valley. You still have Stanford. You still have Berkeley. And you're going to have a lot of growth. Same thing as an example with a market like Portland, Oregon. Portland has all of the issues that you've heard about, that you've read about. It is one of the most exited metros in the US. However, the Portland suburbs like Beaverton, where we own about 1,000 units, have been doing very, very well because a lot of people exit the city, but they don't necessarily exit the MSA. They don't exit the state. So they go to the burbs, and the burbs have rent growth. They have high occupancy. They do very, very well.
Russ, what's your
And
take
then
on that?
the Sun Belt speaks for itself.
You know, I think we have a slightly different approach to how we look at some of these markets than Max. We have very much a research-based approach, and if what I have to say interests anybody on the Pradium Group website, we publish a lot of our research. So we have been at the forefront, really on the institutional real estate kind of investment marketplace, in publishing a lot of our research, first on migration patterns. So the first thing that we did, and this is going back about 15 years, we're really the first to identify this trend, was looking at migration and how that impacts demand for housing. And of course, we were focusing exclusively on rental housing. So demand for housing was important to us. So we started looking at migration patterns and focusing our investments in, you know, sort of the high in migration markets, and de-emphasized any out migration markets. The next step, as we sort of defined sort of our market selection, we started looking at the fiscal condition of the local municipalities, not just the states, but the sub-markets as well. And again, we've published a lot of research. In the US, it's really interesting because there are a lot of unfunded and unaccounted for almost pension and healthcare liabilities that the municipalities and states have. So sort of the thesis being that ultimately taxes will have to go up if a municipality was in worse fiscal condition, and quite frankly, maybe even services would go down, and that would accelerate or decelerate the migration patterns. So we then really built that into our investment thesis, and of course published a bunch of research on it. We then more recently started looking not just at headcount migration, but actually income migration. So if you look at Florida, for example, a much higher percentage, actually 3 times the number of people that migrated to Florida versus Texas, and they're the 2 largest in-migration markets, but 3 times as many people earned over $200,000 versus Texas. So in terms of percentages. So again, we started looking now at income migration, again, thinking that higher incomes sort of bring more to the local economies. In fact, over the last 2 weeks, we've published a piece about the volatility to economies with income migration or out migration. And so that's the latest thing, because some of the markets that Max was talking about, particularly some of the what we call the Sun Belt markets, historically we thought of as more cyclical. And so what we wanted to see was if we were, kind of investing more, concentrating more in some of the markets that could be more cyclical. Remember, cyclicality is beneficial on the way up, but less beneficial on the way down. So actually some of our new research is looking at income migration and specifically how that is impacting the breadth of the economy and the volatility of some of these local economies. So Max, you had highlighted as well the fact that you have to be sensitive to supply. Clearly, we've been very focused on demand and investing where there's been the most demand growth, but at the same time, our underwriting on a deal specific basis has accounted for, kind of supply dynamics as well.
So
Right.
we have about 5 minutes left, so I'm going to take a few questions, and hopefully you'll have the opportunity to finish that sentence as well, Max. So we talked a little bit about the revenue side, the constraint on the pressure on the rent, but also the strength coming from the very strong demand for multifamily units. But let's go to the expense side for a moment. And putting aside or adding to inflation, we also have labor costs, maintenance, and insurance, which has become a huge part of expense. And for many managers who don't have the kind of experience you have, this has come a little bit as a surprise. So how do you manage these expenses and maintain this strong operating margin with the increasing costs? Starting with you, Russ.
Oh, listen, I think it's just an area of focus. People have to be aware. You have to prepare for it. You have to underwrite. Asaf, as you said, there's obviously been high inflation in the U.S. broadly. There's been somewhat of a disruption in the insurance markets. I'd say that the largest increases in expenses have been insurance related. Luckily, it's a relatively small part of the overall budget. But you've seen that. The other place we're very sensitive to as well as property taxes. I mentioned earlier the stresses on the fiscal conditions of local municipalities. And I think particularly with some of the distress in the office sector, combined with some of the other issues, there'll be more stress as well on property taxes. So I think, you just have to account for it. You have to be prepared for it. You have to understand that that is a risk when you're underwriting transactions. And then you just have to be meticulous in doing everything you can to, make sure that your expenses are as low as they can be. Sometimes you're wrong when you underwrite a deal, but you just want to have appropriate margins that hopefully something else works out better than you thought. And then you just have to be meticulous in doing everything you can to keep those expenses as low as possible.
Yeah, it's not that you can't control your revenue. Obviously, if you put more money into the property and you have better marketing, you can increase the revenue. But it's really hard to do that. But expenses is something that you really can and should control.
But you want really good people at your property. Yep. You want your tenants happy. To a certain extent, you can only control labor so much. You can only control insurance. You want to make sure you're adequately protected, and we take our fiduciary responsibilities really seriously. There are some people who change change how investors are protected when insurance goes up to keep insurance costs down. Again, you want to make sure that you are adequately protected as a fiduciary on behalf of investors. So you want to be meticulous in what you do. You want to have relationships with your providers. You want to be detailed and have the best people kind of advising you and helping you when you're going through it. On taxes, we protest our taxes at virtually every property every year. But again, you want to be meticulous, but you want to make sure that the properties, also are not so underwritten, so razor thin, that any one hiccup causes you a severe problem.
So maybe that brings me to the next question for Max, and this is a question from one of the participants. Looking ahead, Max, what do you see as the biggest challenges and opportunities in multifamily investing right now and into 2024?
Not to be obvious, but interest rates are, of course, a huge challenge and opportunity. Well, it's a challenge, which creates an opportunity. The property that we just bought that I mentioned earlier one of the reasons was because they had a rate cap coming up and they wanted to sell it before the rate cap was coming up. And you're going to see more of that. And one other thing, what we're seeing is these interest rates have caused undercapitalized sponsors, owner-operators to fall into distress, which is exactly the property that we're trying to buy right now in Colorado. It's about 75% occupied. Interest rates skyrocketed. They didn't have the capital to manage both the renovations and the operations, as well as the interest rate risk. As well as the interest rate increase. So the property fell into distress. And I think we're going to be seeing more of that. We are seeing more of that, but we're closest on this one. We're seeing some of it in Dallas. We're seeing it in other markets. So I think that's where that lies.
Russ, your take on the question for opportunities in 2024?
Well, I'm gonna start with stresses for because the one thing that we hadn't raised is collections. And I think particularly if the U.S. economy falls into recession, just heads up on collections. We've been very sensitive to that in sort of how we've tenanted our, kind of bought properties and tenants as you go through economic cycles. Max, I know you were talking about occupancy falling off, economic occupancy, particularly in some of the, more stressed properties are probably further stressing the portfolio. And I think, look, this is all the opportunity that's in the marketplace. So far, U.S. markets still have plenty of liquidity. You look at, some of the best buying opportunities, it's when liquidity gets a little more stressed. Right now, we're reasonably liquid. The bid-ask spread, as Max said earlier, is wide on a number of assets. But, I think the stresses that are building in the marketplace are going to create some real opportunities, particularly in our case, combined with all the deliveries. I think that's the thing for us, because we've really been able to take advantage of, sort of lease-up situations in a more stable marketplace, in a more disrupted marketplace. We're really excited for those type of opportunities as we look forward.
So before I get to the last one or two questions, keep on looking at the interest rate, focus on the geographies, and understand the macro and microeconomics of each one of them, employment, the physical state of the municipalities. Are people leaving or coming into that state, and really not just the state, the county and the city as well. Looking at some opportunities at blue states where it might be more challenging to do business, but it also means that there's stronger demand because there's less supply. And then looking into 2024, into some of the opportunities that are going to come from owners that are going to have to sell. Max mentioned this magic number of 18 months to wait until people just say, okay, I can't wait anymore. I have to sell. And I have to say, I know both of you for a while, and I know that even when you buy from someone in distress, you are fair to them, and you make sure that you're not a vulture, because that kind of reputation is not something that you want chasing them. So taking the opportunities, but also being a mensch, and we appreciate that. So I want to ask you two last questions pretty quickly. So what's the most unusual or surprising thing you've encountered while visiting one of your properties? So I know you guys have probably visited hundreds, if not thousands, of properties over the years. Have you ever walked in and said, what is this?
Recently I was at a property and it was in a market. It had a water feature, and there were signs up that said, "Watch out for alligators."
Well, you're in Florida then.
Especially it said, with your dog, pets especially.
Max, any surprises?
Nothing that I want to talk about to an audience this wide. It probably would be inappropriate, but if it was the three of us having a drink, we could have a really good laugh at it. I have walked into units that have just a tremendous amount of guns, either on the coffee table or on the couch or just in ownership of the resident. But when the three of us are in private, I'll tell you some phenomenal stories.
Let's do something else. Next time you're in Israel, you and 70-something people on this call are going to have a drink together, and we'll hear these stories. Favorite amenity that you would install in a property? And I remember in New York, 2005, 2006, before the great financial crisis, things were going crazy. There were spas and dog daycares. Multifamily in the suburbs are a little bit different. Anything you would think about?
I will tell you, all of our properties have pools. They all now have sort of co-working centers. A number of the properties actually have self-serve little, like a convenience store, which we outsource, which is kind of a fun amenity that I think tenants appreciate. I don't think that helps us as much on the marketing side. Amenities, are installed either for marketing purposes or really kind of tenants use them. In one of our properties, we have sort of a golf. You hit it into kind of into a wall, and you could kind of have different holes of golf. The one that I think is most helpful right now, which we're putting into more of our properties, is where we have co-working, which we have at all of our properties, is having some conference rooms. As more people have worked from home, and we have a lot of tenants that are entrepreneurs or salespeople that that don't go into an office. Some don't go into an office every day right now. But having a conference room so that people could, have meetings on site, really saves them from going into an office. And again, what we find is the more amenities we could provide to people on site, such that they don't have to pay for it off site. What I'll say is, when we raise the rent, because our business plan is always to raise the rent, when we raise the rent, they complain less.
So we have one more question here that I have to ask, even though I did not write it. I was tempted to, and we have 2 minutes left, so this is going to be a tough one to answer. What's going to be the influence of the upcoming election later this year? Let's try and be specific on multifamily. Max, let's start with you.
It's interesting. That's an interesting question. Election years here in the US, presidential election years, a lot of the market tends to slow down significantly a few months before the election, because it's, oh my God, what's going to happen? When, in my opinion, the reality is the presidential election doesn't impact our industry nearly as much as state and local. So I'm more focused on that, to be honest. That's where I donate much more. I think about much more involved. There are propositions on the California ballot that I'm much more worried about than I am who's going to be sitting in the White House from a multifamily industry perspective.
Right.
Yeah, Max, I think that's I'll just echo what you said. I mean, most regulations are either city or statewide. So in terms of the regulatory environment, I don't think the election will have much of a difference. And again, like Max, I just don't think the election will make that much of a difference. I think the biggest challenge we have is that neither candidate really wants to address some of the budget deficit, and overspending issues that we have, the deficit issues that we have, which may over time put longer term pressure on interest rates. neither candidate really is talking about really, starting to get the budget in line, the federal budget in line.
Yeah. So
Amen. Amen.
excellent question. And maybe in a few months, when we have a little bit more clarity towards the election, we'll hold this. We'll ask the two of you to join us again and share some of your thoughts, because this really deserves its own 1 hour discussion. I want to thank both of you. I know both of you attract a lot of institutional capital. You have a great track record, and the opportunity to invest with you for and together with Israeli investors is something that we appreciate. I'm going to send everyone some information, everyone that's been on this call, some information about the two firms, as well as the research that Russ has mentioned, which obviously we at Profimex follow very closely. So again, thank you very much. Enjoy the rest of this sunny day in Florida. And for everyone in Israel, or everyone Hebrew speaking, please stay with us, because we're going to take some of these ideas and strategies and put them together into a business plan and into an opportunity. Thanks again, Ross and Max.
Thank you.
Thank you.
And see you soon in Israel.
Great seeing you.